Hey everyone, today I'll be talking to you about Philip Morris, the tobacco company, and specifically I will touch on their management, their investments, their economic moat, my intrinsic valuation, and the risks of investing in tobacco. First off, Philip Morris is a holding company, a company that was created in 1987 to buy and possess shares of other companies. Philip Morris, through its subsidiaries, manufactures and sells cigarettes and other tobacco products in markets outside the U.S. This process is led by the management team, which is graded about a B. This is based on their economic performance. Since the firm's separation from Altria, Philip Morris has delivered total returns in the top half of its peer group, driven by share repurchases and dividend growth in the consumer industry. The chairman and former CEO, Louis Camilleri, contribution provided to have a positive effect for the company. It is believed that he created significant value for shareholders by reshaping Altria from consumer packaged goods conglomerate into two tobacco manufacturers. Philip Morris has a strong track record of double-digit annual returns to shareholders since its creation in 2008. That's when it spun off from Altria. After almost 3 years of the new management, it seems like appropriate capital allocation decisions have been made. Share repurchases have been suspended, a decision that was wise due to the strength of the currency headwind. The heat not burn category better matches smokers' preferences than the other e-cigarette categories. This smoker's preference will most likely influence more people to choose their products. Now, the concept behind heat not burn is that heating tobacco, rather than burning it, reduces or eliminates the formation of many of the compounds that are produced at high temperatures associated with combustion. And this investment would give it early leadership of the category and sets the firm up for long-term growth. Now, their strong intangible assets, like marketing research insights, are at the core of Philip Morris's wide economic moat. In addition, the company's platform of total tobacco products and e-cigarettes gives it economies of scope and scale. Now, the addictive nature of tobacco products makes demand fairly price inelastic, and the fact that tobacco is a consumable product doesn't hurt. There are very few similar substitute products existing outside of the big tobacco firms, so a favorable industry structure exists. Now, the company is the largest cigarette manufacturer outside of China and is the only one of the largest four players, excluding China National Tobacco, to have increased its market share since 2008. And my estimated price per share for Philip Morris is $95. This implies a 2016 price to earnings multiple of 21 times, a price to share multiple of 5.3 times, and a dividend yield of 4.5%. My estimate is based on two key valuation drivers: the trends from Philip Morris's past performances and the trends from the public. I forecasted the revenue to have a negative growth rate of 7%. This is due to the past performance of Philip Morris, as well as the decline of smokers. The percentage of adult smokers has declined from 20.9% in 2005 to 15.1% in 2015. Their revenue has also been declining since around 2012, and so has their operating income, operating margin percent, net income, diluted earnings per share, and free cash flow. Furthermore, as of August 8, 2016, the FDA has the power to regulate all tobacco products. Considering that tobacco is the single largest preventable cause of death, disease in the United States, the regulations against tobacco are only going to get more and more strict. The risks of investing in Philip Morris International today is about average. Their price power is intact, and unless the government steps in, the only operational risk I see is the possibility of more plain packaging measures and advertising regulations being placed on them, especially in larger markets, as well as taxes from the government as well. And about the plain packaging measures, basically that's exactly how it sounds. their packages will be plain, so consumers will not be able to tell the difference between the tobacco brands. And although the tobacco business is stable for the most part, the threat of government intervention through large excess tax increases, for example, is omnipresent. Taxes represent more than half the price of cigarettes. If excess taxes were to be increased even more than they are now, this would force Philip Morris to increase the prices of their products. So, some advisors and investors believe they will be able to bounce back from the current trend of negative downward growth. This is most likely due to their investments in the heat not burn category. And Philip Morris is still a multi-billion-dollar company and has a chance to do well in the future because of the heat not burn category, as well as consumers needing their tobacco products. For this reason, I suggest that investors should hold on to their current stocks in the firm to wait and see if things heat up for Philip Morris. Thank you.